This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, you're listening to the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, here with your weekly dose of chat and analysis about the big events affecting our personal finances. Now, for everything about savings, investments, pensions, and all things money, you've come to the right place. Joining me this week is Danni Hewson. Hi there, Danni.
Hi, Dan. Hello to everybody. Interest rates, of course, have been dominating the news for years. And again, this week, they have been top of the agenda. We're going to unpack what the big rate cuts in the US mean for investors around the world.
Now, changes to rates now, or potentially in the near future, mean that interest rates are also changing on cash savings. So we're going to take a look at the latest trends and why the financial regulator has issued a warning to the public about cash. We're also going to chat about the tax implications of so many people having taken advantage of higher interest rates on cash in recent years.
A lot of people have made good returns from owning shares in Rolls-Royce over the past few years, so we thought it was worth getting a fund manager on the show to talk about what could happen next for the business. They also discussed the outlook for Primark and its owner, Associated British Foods.
There's a lot going on in the property sector with new data on house prices, deals galore among housebuilders, and a big share price rally from one of the UK's best-known DIY companies. So stay tuned for more information.
And if you're one of the many people who prefer to pay insurance premiums on a monthly basis, you might be alarmed by some new figures, which we'll discuss later in the podcast.
And finally, we're less than 100 days until Christmas. And would you believe it? People are already talking about festive spending. So before we go into the details on that, let's start with the big news of the week, which is, of course, US interest rates have finally come down. Now, this does matter to people around the world, not just those in the US. So, Danni, tell us everything about what's been going on.
Yeah, I think it was something of a surprise. Lots of analysts had expected that the United States Federal Reserve would cut interest rates by just 25 basis points. And actually, when the cut came, the first cut since the pandemic, it was actually 50 basis points. Now, in the couple of days leading up to that, market expectation had edged more towards that. So it wasn't a massive shock for markets, but certainly I think a lot of people have read into what it potentially means about the strength or otherwise of the US economy. Now, I think it's really important that we don't forget that we are in an election cycle. And of course, a lot of people have looked at this rate cut through a political lens. The next time we hear from the Federal Reserve will be after we know who becomes the next United States president. Now, Jerome Powell was very clear that it wasn't because of concerns about the strength of the US economy that they made such a big cut. It was purely that they were getting back to normal, that the inflation story had changed sufficiently to allow them to now cut interest rates and get back to sort of the status quo. I don't think anyone will be surprised that Donald Trump took that cut as a sign that the economy wasn't as strong as many people believe. And actually, it rings a few alarm bells. It was really interesting to see market reaction in the wake of the cut, because initially it was kind of like, woohoo, the champagne has been popped, everyone's celebrating. We saw the Dow Jones, the S&P 500 hit intraday highs, but actually closed down. Gold also rallied, which does suggest that there are one or two potential niggles in the air, a little bit of disquiet about why such a big cut was handed out. Now, I think it's also important to note that the Federal Reserve was a bit behind the curve because we've seen two cuts now from the European Central Bank. We've seen a cut from the Bank of England. And I stress we are recording this on Thursday morning, 2 hours before we get the next announcement from the Bank of England, although we don't expect any changes, not least because there is no press conference afterwards. And of course, it's really important when we make these changes that we hear some of the context surrounding them. And a lot of people were paying attention to what Jerome Powell said and also those dot plots about where interest rates might go next. Now, you were saying earlier, why is the US central bank decision so important to investors around the world? Why does it have such a big impact on stock markets? Well, let's be fair, we're talking about the Fed really as the global central bank, and where it leads, a lot of other central banks, well, they don't necessarily follow, but they don't want to get left behind. They don't want to be sort of out of step. So we really now seem to have hit the top of the rate hike cycle. We're definitely on the downward curve. And for all of those companies, those huge exporters that look to the United States for market share, then this decision is a boost. So we did see a lot of those big international companies making gains in the wake. And certainly waking up this morning, Asia was a sea of green. London's FTSE 100 opened up, really on the front foot. Because if the United States consumer is feeling a little bit freer with their spending, a little less constrained, then that potentially will have a knock on to the kind of sales figures that are made by some of those big companies. And we know that some of those big companies, I'm thinking about the likes of McDonald's, they have been hurt by a weak United States consumer. So I think it was an interesting night. It's been fascinating to watch market reaction and fascinating to hear a lot of the talk in the wake of it about what people feel, whether or not it's a normalizing or whether or not it hints at something maybe a little concerning under the surface, Dan.
Yeah, because I think normally when interest rates when a central bank decides to cut interest rates, typically you'd see a quarter percentage point, so a 25 basis point cut. The fact that the Fed's done double that, on paper, if you just looked at it, you think, okay, they're clearly worried about something. But like you say at the start, it's trying to either play catch up or just wants to be ahead of the curve in terms of trying to be proactive and saying, look, it definitely gave the message we're not panicking about the state of the economy, but we think it's appropriate to take this now and normalize. You could say it's normalizing, but there's sort of indication that this is not the only rate cut we'll get for in the short term. But I am very interested in the market reaction. I am quite surprised that the markets have certainly as we record this, seem to be going up on the news. If you think that equity markets have done fantastically well all year, and you've made some really good returns, particularly in the US stock market, because everyone was already expecting the rate cuts to happen. So now we've got them. I feel like the narrative is going to move on to the next stage, and there'll be some worries potentially still to come. So while it may all seem happy as Larry now, it only takes one economic data point to trouble people. And the Fed's sort of saying we're going to look more closely at the labour market. So next time we get some jobs data, if it's not quite what the market wants, unfortunately we might see some more volatility on the markets. But in terms of sort of what's going on in the UK, like Danny says, we're recording this before the Bank of England made its decision. You already know the answer by the time you hear this podcast. We take the assumption that nothing will change. And part of that is because we had some inflation figures earlier this week. If you think that the Bank of England has had rates high to try and combat inflation, stop it racing ahead, it wants to get it down towards 2% target. Well, in August, inflation didn't move. It's still stuck above target at 2.2%. But actually, if you just take a step back, there's a lot of positive things for the consumer, particularly when it comes to things like filling up your car with petrol, filling your kitchen cupboard with food. August had the 17th consecutive month of falling food inflation. So obviously, this is good news. But the thing that might have stopped the Bank of England from changing rates, or certainly it's been troubling the market, is the fact that services inflation still remains really high. It's at 5.6% in August, and that's partially down to airfares jumping up. So if you go back to early summer, all the big airlines were sort of saying, actually, look, people are booking flights at the very last minute. It's really difficult to know what's going on. So the only way to try and drum up business is to cut fares. So we had a bit of a price war. That seems to be now sort of normalizing. So Ryanair's shares slumped in July when it reported ticket prices have seen annual falls of 15% in the 3 months to the end of June. But the fact that Michael Leary now says the 3 months to the end of September should only see reduction in prices by about 5 to 9% does show that there's a shift in thinking that sort of implies that perhaps consumers are sort of booking a little bit ahead, a bit more confidence in what's going on. But, overall, who knew the airline sector was so crucial to what's going on? And also, it's just a reminder that if you don't really sort of follow what's going on in the world of economics and you want to sort of properly understand how markets work, it does pay to keep a close eye to try and sort of join the dots about what's going on, really. But let's turn our attention to the world of cash, because there's also a lot going on, and that's also impacted by interest rate expectations as well. So, Danni, should we start with the tax angle, the fact that so many people are invested in cash at the moment and what that really means for them?
Yeah, it's been a bit of a sting in the tail, hasn't it? The fact that we've seen interest rates finally at some decent levels to give people a bit of decent interest on their cash savings. But of course, the flip side is, as you earn more interest on your cash, if that cash isn't protected in some kind of tax wrapper, then the tax man can come knocking. And that's exactly what has happened. Almost 2.1 million people are expected to pay tax on their savings this year. That's up from around 650,000 just 3 years ago. Now, this is according to data that we've crunched from a Freedom of Information request made by our fellow colleagues at AJ Bell. Now, this is lower than what had been initially forecast by the government. 2.7 million people were expected to be hit by tax. So I think some of the reasons behind the fact that we haven't seen as many people being hit by tax is those warnings that we've been banging on about, saying, look, don't forget your personal allowance, £1,000 for basic rate taxpayers, £500 for higher rate taxpayers, additional rate taxpayer, absolutely zip. People have paid attention to that. So we have seen record inflows in cash ISAs on a number of months over this year. Also, one of the reasons is, despite the fact that I'm sure no one listening to this podcast has done it, but I do know certainly we've spoken to lots of people that have, that they've not interacted with their cash savings at all. They've left all that cash languishing in old savings account, earning, well, pretty much zip. I mean, the Bank of England data shows that £252 billion of money is sitting in accounts earning no interest. Now, there are a few traps and tricks that I think it is worth mentioning in all of this. You are taxed on the interest on your savings when it is accessible by you. So think about when that comes to maturity. In terms of tax purposes, it could all be counted in one tax year. So that could nip you over that personal savings allowance. So do take a look at the kind of account you've got, or of course, think about a fixed term ISA account. Also, a little known rule means that you might have to pay tax on interest that's earned on your child's savings. So that means once a child earns £100 or more in interest on money that's been gifted by parents, it is taxed as though it is the parent's money. Now, if you're nowhere near that limit, it won't be an issue, but if you are, you might want to consider looking at something like a junior ISA account, or you can split the money that you give between parents so you can ensure that you are making equal payments to children. The personal savings allowance also could be wiped out altogether, as we said, if you move into the next tax bracket. So really keep an eye on that. And also remember that interest savings counts towards that limit. So this is something I know a lot of people aren't aware of. Also, joint savings. If you've got savings in joint account, then that means the interest is split 50-50 between two account holders. So, again, if you've got one couple who is a lower earner in a lower tax bracket, it might make sense to move the savings into their account. And finally, with an investment fund, and this is one I think that trips a lot of people up, If the fund invests more than 60% in bonds and cash, then payments from the funds are classed as interest rather than dividends. So the best way to avoid that is to use a stocks and shares ISA for your investments, or an innovative finance ISA for any peer-to-peer investments that you have, so no tax is due. Although, of course, those ISA allowances are very much part and parcel of all that. So just check how much you have left in your allowance pot.
So obviously we talk about tax there, but the other key thing that's going on is the actual rate that you're getting on cash savings. Because I don't know about you, Danny, I am getting sick of notifications on my phone or email telling me that rates have gone down on my savings account. It's quite miserable. I mean, there's a company called Moneyfacts which does lots of analysis about trends on the financial markets. It says that savers looking for longer term options for their cash will now find that the average rates have dipped below 4% for the first time since spring 2023. So obviously these savings rates are decided by the savings provider, the bank, the building society, and they're taking a view about where UK interest rates are going. And I think the direction seems to be downward. So the average longer term fixed bond rate, so this is a term of more than 550 days on the market, fell to 3.99% at the start of September. That's down from 4.13% in early August. But a year ago, you could have got 5.12% on a longer term savings bond. So you can definitely see things are changing a lot. So, Moneyfacts assume that if you had a £5,000 in an account and took average rates from the first available day each month. So someone putting that £5,000 into a longer term bond for 2 years at September 2023's average rate could have got £525 in interest. But under the rate typically available now, that interest would only be £407. So it's just to be aware that obviously that this is happening across the board. It's not simply just the longer term savings bonds that you're seeing here. No, it is lots and lots of different accounts. So if you haven't looked to see where your cash is and what you're getting for it, and if you're on a certain fixed term or just an easy access rate, you might want to do a little bit of research to see could you get something better. And of course that leads us nicely into something that the financial regulator has been saying.
Yeah, the FCA has been urging people to shop around for the best cash deals that they can. It reckons that savers are an estimated £4 billion better off following improvements to easy access rates in recent months. The FCA says that savers should, though, shop around, particularly now as rates are falling. And in fact, it found that there were 174 instant access no notice accounts that offered over 4% interest in August, although some of the bigger firms continue to pay below average for easy access products. Now, as Dan was saying, those rates are coming down quite quickly. So at the moment, no easy access cash ISA rates offering above 5%. But if you search around, particularly looking at the likes of price comparison sites, you might be able to find better deals, but sometimes those comparison sites miss the best deals. So several investment providers, including AJ Bell's own Doddle ISA, pays 5% or more on cash. So that's an attractive rate of interest. And you've then got the option to invest some of that cash as well if you choose. So the best of both worlds, cash and investments, the flexibility to hold them in the same ISA. Also, we know we've been calling for ages for a more simplified ISA system where providers can offer both cash savings and investment products within a single ISA tax wrapper, because that would really help when people are looking just those comparison services, just looking at cash ISA interest rates. Now, I would say that for people holding cash outside an ISA, then using a savings platform can also make it much easier to search for the best deals. And certainly AJ Bell's Cash Savings Hub offers deals from a range of banks within a single hub, and rates there of 5% are available to savers. Right, it is time for our first guest. Mark Costar is a senior fund manager at JO Hambro. Dan recently caught up with Mark to discuss two stocks on the UK market. One is a giant on the high street. The other is a well-known British engineer. Let's hear what they had to say.
So Mark, first stock I want to talk to you about is Associated British Foods. I think most people listening to this podcast will be familiar with its retail chain Primark, but it also owns businesses that are active in various sort of food brands you might find in your cupboard at home. It also does things like sugar, agricultural stuff. For you as an investor, is your interest in this business because it's like a conglomerate? Does lots of different things and it's sort of diversified revenue, or is your interest primarily the opportunities for Primark as a retail business?
Okay, great. Thanks, Dan. Well, it's a bit of both, actually, because Primark is a global growth powerhouse that we think is materially undervalued in the current ABF price today. Why do we think that? Well, part of the reason is a bit like you referred to there, is that it is a conglomerate. There are some quite noisy and volatile businesses in there, which are quite a small component of profits, but do move around quite a lot. And that often distracts investors from the core and key attractions in this business. Primark is a global value retailer with very strong ethical credentials that resonates very strongly with its consumer groups. That's why it's continued to gain market share across multiple territories. It's one of the few UK domestic orientated retailers who has proven to be a success in the US, and there's significant scale growth opportunities there. It's proving to be very good in Central and Eastern Europe in particular, which is the latter being a very strong and exciting area of growth. And in the medium term, there's really exciting growth optionalities in both the Middle East and in India as well. So we think Primark profits can comfortably more than double and potentially treble on successful execution. So we think that's completely mispriced in the current value of ABF equity. Of the remaining business, it also does have some world-class grocery brands, as you mentioned, Twinings and with healthy infusions, and herbal teas, and Ovaltine, actually, which is perceived in the UK as an OEP's before bedtime drink, but its roots are as a formula for infant and growing adolescent nutrition, and it's in that light and that level of consumption that's seeing it post consistent growth in multiple territories.
So on just a question on Primark. I mean, I think a lot of people sort of associate it with a place you can go and get like a t-shirt for £2 maybe. But I went there the other day and I was walking around and I thought actually it seems to have more expensive stuff these days. You can find tops that are £20. And actually there was a store in London I visited. It had a concession. It was like I think it was Worn vintage clothing. It seemed to be another company was selling it, and they were considerably more. Is the direction of travel for Primark to start? You still have its basic cheap stuff, but is it trying to increase its earnings by offering sort of higher quality clothes at a much higher price?
I'd say high quality clothes. I wouldn't necessarily at a higher price point. I mean, obviously some prices have gone up with recent inflation over the last couple of years, but also they're looking at more sustainable and recycled materials, which do carry a slightly higher price point as well. But I think 55% of products currently are the sustainable or recycled material. That number is also looking to go higher as well. So the mix and quality of what Primark offers is very differentiated from some of the other budget and discount retailers. You can also recycle clothes at most of the main stores. I'm sure if you visited one, you would have seen some of the clothing banks there as well. So they're doing a lot on that front. I mean, there are some slightly higher priced ranges, just like there are in any retail store, but that's not core to the central proposition, which is resonating with its core consumer as an excellent value for money retailer.
So it's got it certainly had a trial of a click and collect service where you can go, if I'm right in saying you could see what's in stock in your local store, and you can order that, pick it up in the shop, but it doesn't ever seem to want to do a full transactional web service. It's just the pushback always seems to be, our clothes the price point's just too low to justify letting someone order something that could cost £2, but they could spend more than that on the postage if they want it delivered. Do you think that there's ever going to be a stage where it will have a full online transactional platform?
I think only as and when the economics allow it, Dan. And I think they're very rational in allocating their capital, because you'd have seen with a number of online retailers like a Boohoo or ASOS or anyone else, they've got in significant trouble now because the cost of customer returns and, of course, the emissions that creates is a considerable problem. And they're having to shut off a number of their loss-making customers as a result of that. So we did see a boom during COVID, but I mean, you're probably aware that the online penetration of clothing retail has actually stagnated since. It's not continued to grow, unlike other categories that people want the touch and feel and everything else. So I think ABF, wisely, despite being under pressure, waited to implement that. It means they can implement next generation technology. It gives them very rich data from which to improve and iterate their product ranges. And of course, they haven't had all these logistical and delivery complications. I mean, you may have seen Boohoo have just shut down their warehouse just in the US just this week, for example. A Pretty Little Thing was shutting off people from the lower end of their customer base. So a lot of these early movers and noisemakers in online clothing retail are the ones that are struggling the most right now.
So does it suggest that Primark, it's obviously there's still seems to be still opportunities to roll out a lot more stores in the UK and overseas? Do you think it might look at different format stores? If its business is going to be physical stores, could it have like a mini Primark somewhere? Or do you think actually it's made its name by having big volumes of products, therefore it needs big volume of footprint per store? They're going to be bigger and bigger and bigger, not small, not tiny ones.
Well, I think the answer to the question is they tailor the store size to local markets and cultural norms and what works best and resonates best with the consumers in those markets. So they have experimented with different store sizes. In Germany, for example, the store size is considerably smaller than when they initially launched. And similar in the US, actually, where the average store size now they found the optimum footprint, which is smaller than some of the larger stores you might see in the UK, but works very well for the local consumer there. So the answer is they're always going to have a larger average store size than most retailers, but not necessarily the big giant ones you might always associate them with that you see in some of the city centres in the UK.
Okay, so I wanted to ask you about Rolls-Royce. It's a bit of a a darling of the UK stock market in the last couple of years. It's delivered pretty strong returns, much more than you perhaps would expect from your average stock. So this is all on the premise of a turnaround for the business. So are you a fan of Rolls-Royce? Do you think it's there's clear evidence of a turnaround, or do you think it's still the share price is going up because of hope, not the reality of change?
Okay, well, we've owned Rolls-Royce all the way through that period, and there is very compelling. It's not just a turnaround. There is medium and long-term structural growth in this business. So in the short term, of course, there is a recovery in engine flying hours, and we've seen that post-COVID. And that business continues to generate cash. They've executed extremely well on that. But Rolls-Royce is a lot more than just airline flying hours. There's very significant structural growth opportunities, which we believe are still materially underestimated in the share price. I'll give you a couple of examples. The power systems business, for example, as an underpin for AI data centers, it is really strong growth, was highlighted specifically in the recent results, and we had a recent meeting with the company, and they seem a lot more excited in private than they are in their public prestations about the growth potential for that business. And you've got small modular nuclear reactors, and there's two legs to this. I think it's commonly accepted that nuclear needs to be an important part of the energy mix on a go-forward basis. Small modular nuclear reactors are fantastically, potentially efficient, off-grid, fully renewable solutions that can work well with data centers and other power sources. And of course, Rolls-Royce have 60 years experience in small nuclear from their nuclear powered submarines exposure dating back to the 1950s. And that is a fantastic global growth opportunity there. And indeed, the submarines and defense business, I mean, sadly, with rising escalation in the South China Sea, Naval warfare and submarines in particular are seeing structural growth in defence budgets, and Rolls-Royce is ideally placed to help service the powering needs for those vehicle fleet as well. So there's also the narrow body opportunity in the core engines business, because Rolls-Royce is currently purely just a wide body business, as you're aware. That narrow body business could be potentially very attractive in the medium term. The UltraFan engine is 15 to 20% more efficient than anything else out there. It's at very advanced stages of development now, because the company continues to invest very significantly in research and development. That's a great example of where that's paying off.
We had an issue with Cathay Pacific a few weeks ago. Found a problem with one of its Rolls-Royce supplied engines. I mean, Rolls-Royce share price had a little bit of a wobble on that, but do you think this is, potentially a big risk to earnings if we find that other airline customers who use its engines find problems? It could hurt its reputation, to stop this sort of share price rally in its tracks, because it's not the first time Rolls-Royce has been through sort of an issue with customers and its engines.
No, it's not. But it's actually, if you look across it's a prevailing feature of the industry, because they're pushing the boundaries of physics with the engines, at the behest of the airlines and the customers who want them to obviously be more fuel efficient, lighter, and better powered aircraft. So you'll see Pratt & Whitney, GE, everyone has got specific issues, and Rolls-Royce in that context are significantly, they're relatively insignificant. All those have been fixed. They're back up and flying now, so I don't see that as an issue. Is it something that could emerge in the future? Given the advanced technologies that are employed, you can never rule that out. It does come with the territory. But if you look at the compelling returns and the efficiency gains that their engines deliver, they vastly outperform the competition across a wide spectrum of metrics.
That was Mark Costar from JO Hambro.
I hope everyone at home enjoyed that interview. And if anyone would like to hear one of our experts talk about a particular mid or large cap stock, or we can get a fund manager on to chat with us, send us an email and we'll do our best to find someone suitable. So the email address is podcast@ajbell.co.uk. So Danny, should we talk about property now?
Yeah, I mean, this all links to interest rates as well, doesn't it? It's almost as if we planned it, Dan.
Yeah.
But what we've seen over the last, couple of years actually has been an awful lot of M&A activity in the property sector. And just in the last couple of days, we had news from Legal & General, the huge insurance and asset management giant. They've struck a deal to sell their house building subsidiary, Cala, back to its previous owners. Now, that transaction's worth £1.35 billion. So this is investment firm Sixth Street Partners and Patron Capital teaming up to purchase one of the UK's top 10 house builders. And I was looking at some of the numbers. The company employs over 1,300 staff, and it sold just shy of 3,000 homes last year. Now, of course, house building has been a huge point of political interest, and a lot of people I know have really struggled, particularly to try and find affordable homes. And we've also, of course, had high interest rates, which have meant that for a lot of people, buying a home at the moment has been unaffordable, to try and get the deposit together, but then to cover the cost of the mortgage, which has meant that house builders have been through something of a really tricky time. We've had really high inflation, high labour costs, a shortage of some goods and materials, and confidence really down, which has meant that the number of completions have been down, costs have gone up. And that is why, in some cases, we have seen some real interest in trying to merge companies together in order to try and take advantage of some cost savings. And it was really interesting because I was taking a look at Vistry, one of the home builders, of course, which seems to have sort of sailed through the period. Certainly, the start of the year, it really seemed to have been bucking the trend. And a lot of that is down to its acquisition of Countryside a couple of years ago, which helped with some cost-cutting measures and also increased the land bank. And now we're at a point where we're hearing a lot of encouraging words from the new Labour government about changing the planning system, about reattaching figures, house building targets, and really sort of creating a backdrop to get Britain building. This gives house builders big opportunity. And we've seen, of course, the Barratt Redrow deal on the cusp of going through. They're expecting 90 million in savings there. They're just waiting for the final sign-off from the Competitions and Market Authority. Although there was another deal which looked like it might go through in the summer. Bellway was looking to take over Crest Nicholson. That didn't quite get over the line. But I think this is a sector where potentially we could see more M&A activity going forward, because when you get to a period where you've got the expectation of a bit of an explosion, then house builders want to make sure that they are in the best position to take advantage of that. And of course, if they haven't been padding out their land bank, they haven't been buying land in order to build the next generation of homes because they've been a bit nervous about how many homes they wanted to build because we've seen quite a subdued housing market, then it can take a while to get going again. And of course, we always know that when things start to explode, the company that is in the best position to take first advantage of things is often the one that, really dominates and really does do well.
Yeah, I think that, these house builders clearly can see what's going on. You've got mortgages are slowly getting cheaper. Obviously, the government policies are sort of pro-housing. And there are signs that the property market is strengthening. So you can see why they want to be able to get themselves positioned right now and ride that recovery. And you just have to look at we just had some new figures out from Rightmove that said the average price tag on a home jumped by nearly £3,000 in September. So to reach £370,000, 759. So that 0.8% increase is actually twice the long-term average growth rate. So I think that's quite interesting. I think it's because we've got mortgage rates edging downwards, property choice for buyers has grown, and for many people, earnings are still growing faster than inflation. So I think some people's confidence is just coming back, and so it does totally make sense that the house builders are trying to sort themselves out. So interesting, it's not just the house builders who sort of starting to grow a little bit more confident about the future. We've also got people that benefit from more activity in the housing market. And one that really springs to mind is Kingfisher, the owner of B&Q and Screwfix. So obviously, as a DIY sort of merchant, it did very well during the pandemic. During lockdown, we were at home. Loads of people spent loads of money on stuff, doing up their house or flat. Then as people started to go back to work in the office, spent less time at home, it found life harder. So expectations have been quite low for this business. It's been going through a really difficult patch. But if you look at its latest results, there's no growth in earnings at all, no growth in sales. The dividend's flat as well. But the share price is up by 18% in a week. So you do think, okay, what's going on there? And what's driving that share price rally is upgraded guidance for the amount of cash flow from the business. It's buying back more shares. It's got its eye on the future, and it's starting to feel a little bit more confident here. So the market is effectively judging Kingfisher as a turnaround story. And I think that if it can sort out ongoing problems in its French arm and ride this potential tailwind for the UK property market, I think that B&Q's owner might be looking a little bit smart after quite a few difficult few years sort of post-pandemic.
I have spent a lot of time in B&Q over the last couple of weeks. And can I just say, how insanely expensive is it just to get one of those tester pots for paint? I mean, I think I paid £5 for one, and you think, I'm only going to put like a square on the wall. I mean, absolutely bonkers, but it was full. It was absolutely bustling when I went there. We've got time just for a couple of quick bits before the end of the show. First is an alarming stat about insurance. And I'm sure if you've had to change your insurance, renew policies recently, you've probably had all the blurb when you have finally finished signing on the dotted line about how much extra it's going to cost you if you want to pay monthly. And the consumer watchdog Which has been looking at this, and it's got really cross. And I must admit, when you hear how much people are being charged, as much as 45% the rates on paying monthly. And of course, Which is saying that a lot of the time, these customers who have to get home and car insurance, these are necessities, but they're not doing it out of choice paying monthly. They're doing it because it is unaffordable for them to do otherwise. And we've also had the FCA saying, look, premium finance is an important product. It's relied on many people to pay the insurance cover that they need. And firms need to assure themselves and be able to assure us that any product they sell provides fair value. So I think it's fair to say that the FCA is going to take a really good look at that. But for a lot of people, it is just unaffordable to pay for your home insurance or your car insurance in one bulk buy. So a lot of people are going that monthly route because also it allows you to budget much more easily. But you do need to be aware that you are going to be paying more for a product than you would if you could pay it all in one go.
Yeah, because I've certainly come across insurance providers that they charge you more, but I've also seen ones that essentially, if you divided your annual policy by 12, it would be the same as a monthly stat. So, it's almost like it's a utility, isn't it? We've got to pay it. Everyone needs it, and so you've got to have it, insurance to drive on the road, etc. So, it's almost like it's a shame that there shouldn't be a rule. It should be a rule, I should say, to say that your monthly should be the same effective cost as the annual when you add it all up. So, but yeah, definitely one to watch. Certainly when you get these sort of campaigns and regulators sort of looking at these things, you do sort of suggest that there are going to be some change coming down the road. But we got one more thing I just want to mention. I know it's only September, but I wanted to mention Christmas. There's less than 100 days to go. So, Danni, I presume you've done your shopping, have you?
One year I did actually start really early when my kids were small, but then I lost the bag of stuff that I'd bought and couldn't remember what else I'd bought. And by the time I found it, which was almost Christmas, I realized then I double bought everything. So no, I'm really last minute, I'm afraid.
Well, John Lewis has just issued a sort of an early hint of its Christmas ad with a new campaign just come out. We've also had a few interesting sort of surveys. So ClearPay's just sort of been sort of totting up what people bought last year, sort of noting that 31% rise in sales of advent calendars containing gin. That's quite interesting, isn't it? So, but we've also got a survey from Rakuten, which says 1 in 4 people have got a head start on their Christmas shopping already. And some of them are suffering from something called FOSO, which I've not heard of before. Do you know what do you reckon that stands for, Danni?
Well, FOMO is fear of missing out. FOSO, fear of selling out.
Yeah, exactly. They're worried that the things that they want are going to be bought by everyone else, and when they come to buy it, it's not going to be in stock. So, yeah. So FOSO, it's something to think about. But I just think I can understand some parents perhaps wanting to ensure that it's an exciting time for children, that you want to make sure you've got everything you need. But I think for the average person, they're not thinking about this at all. I mean, you're only just starting to see things like Halloween stuff get into the shops, let alone the next seasonal thing. But across the pond, Target, one of the really big US retailers, see it's hiring 100,000 people to work in its shops for Christmas. That's pretty incredible, isn't it?
It is incredible. But I noticed as well that Domino's here in the UK is also, I think it's 5,000 staff that they're taking on at the moment, because they're expecting lots of us to eat pizzas in the run up to Christmas, which was fascinating. And what is interesting that we saw last year in a lot of the ONS figures, looking at inflation and retail sales, was people last year were really budgeting hard. So they were starting to buy things like cakes and biscuits back in September, because that way they knew that they would have all the little luxuries that they normally associate with Christmas and that they could afford to do it. But also something that we had, our Money Matters podcast, we did a podcast about Christmas last year. And one of our guests, who was a retail expert, was saying you get loads of offers in the run up to Christmas, especially on things like wine, where you get, buy 6 bottles, get 25% off, and those offers will disappear. So if you are smart, you can take advantage and save some serious cash. So if you do see an offer on something that you would buy anyway, then I think it is worth acting on it.
Well, I think you got to be have some restraint though, otherwise you'd be diving into the wine and the boxes of Twiglets and stuff well ahead of time. That's the thing. You have to get a lock and key and put them away somewhere.
I've just learned so much about what goes on in the Coatsworth family Christmas holidays. That is all we've got time for this week. Don't miss next week's show, where we're hoping to have another big name fund manager on the show, and Tom Sieber will be here to celebrate Shares Magazine's 25th birthday. Until then, thanks for listening, and please do leave us a review if you have time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.